So NEO stock is actually up quite a bit today at up 3.7. So NEO stock is actually up quite a bit today at 3.77%, while the rest of the market is actually down a little bit and has had a pretty rough time over the past few months. So NEO Inc. is actually a Shanghai-based Chinese electric vehicle manufacturer. Some people call it the Tesla of China. They have some really cool things that they do, and I've heard that they're one of those companies that's actually taking a little bit of the Tesla market share. Maybe not as much in the United States yet, but in other parts of the world like Europe. You can see they're decent looking cars as well. And they have this really cool technology where they actually do battery swapping instead of you having to sit there and charge your vehicle for hours. So you go through these stations, you drive through, and it like swaps your battery out really fast, as you can see in this video. And then it essentially allows you to be in and out in just a few minutes. I think they said it's like 3 minutes to get it changed in and out. It's really smart, actually. So they just apparently had their first operating profit in Q4 2025, and that's one of the reasons that they've had an upward swing on their stock, whereas before they were struggling. Now they're still down over the past 6 months, down almost 28%. If you look over the past year, though, they are up almost 45%. And over the past 5 years, they're actually down about 86%. So you're getting some mixed signals here and some mixed returns. Depending on when you bought, you could be really happy or really pissed off. Now, if you compare that to the S&P 500, which I usually call the gold standard of growth stocks, of course, and it being an ETF, of course, is fully diversified. So if you're buying individual stocks like NEO, you're probably trying to beat the S&P 500, which over the past 6 months is down 5%. It's up 13% in the past year and is up almost 58% in the past 5 years. So this is what you're trying to beat if you're buying a stock like NEO, in my opinion. Now, if you look at their year-over-year quarterly financials, they look really good. They're up 75.86% in revenue, up 101% in net income and diluted EPS, as well as net profit margin. If you look at their last few earnings calls, this one they beat by 441% on EPS and beat on revenue by 4.21%, whereas they did kind of struggle on some of those over the past 3 quarters before that. Now, they don't seem to offer a dividend, and their PE ratio is not showing on Google Finance right now. They're also a fairly cheap stock at $5.51 USD. I would like to see their assets versus liabilities a little bit better than a 1-to-1 ratio or so, but they also just now apparently had a profitable quarter, and their orders apparently are up as well. Return on assets is pretty low, 1.71%. It's not quite ideal. Return on capital is not quite ideal either at 5.13%. Both of those should be probably closer to 8 to 10% or higher. If you look at the past 3 months, they're actually basically about even at minus 0.18%, when this is, of course, the equivalent of a quarter. That's why I look at 3 months as well. They do have a price to earnings ratio here on Robinhood. It says it's a negative 5.46, which usually is what you see when a company is not fully profitable yet. Now, we do have 28 people who have given ratings here, which is not quite as big of a sample size as a lot of the stocks I've covered recently, but 64% give them a buy score, 32% say hold, and 3.6% say sell. So that's just according to Wall Street analysts. Now, if you look how they've been doing on earnings, estimated versus actual, they had some pretty mixed results, but the last few quarters, it seems like they've done pretty well on earnings. But it looks like they lowered guidance a little bit between Q4 and Q1. Now, again, that's still much higher than Q1 of last year, so that's a good sign as well. So they do expect apparently better results year over year versus Q1 of last year. Now, they do have a negative EV to EBITDA ratio, which again, if you're not profitable, you're probably going to have a negative ratio like this. So PE ratios and EV to EBITDA ratios are going to look pretty bad for a company that's not profitable. They're also ranked worse than 100% of vehicles and parts industry companies according to this. But again, that's because it's negative. It also messes up your PEG ratios as well, so this makes it essentially useless because the PEG ratio is a 0, again, because they are not profitable. As far as reviews go at NEO, they have a 3.7 out of 5-star rating, 61% recommend working here to a friend, 64% approve of the CEO. So it doesn't seem like they have a bad leadership issue or anything like that. There are some things like, well, senior management scores and career opportunities could be a little bit better, but overall, I wouldn't say there's red flags here about their leadership based on what employees are saying. So the argument for if you wanted to talk yourself into buying, it would be like, well, they just got their first profitable quarter, their orders are up, they may be able to take away some market share from Tesla, and they have some really cool technologies like their battery swapping design and all of that. Maybe they can start trending up from here. They're really far from their all-time high. If they got anywhere close to their all-time high again, you would be 10xing your investment. But of course, they have a long way to go to accomplish that. It's also cheap right now, so maybe you could see it as a low risk, high reward type of buy. But that's only if you're trying to convince yourself it's a buy right now, which I am not saying it is, of course. If you already had it, I would be surprised if you held it through everything that's been going on, or maybe you had it and you bought recently, maybe like last quarter. That would be a totally different story. But if you already had it and you just saw what happened this past quarter, I don't see why you would necessarily get rid of it right now. Maybe the worst is behind them. It's hard to say. Now, as far as whether you should sell, I don't know why you would do that after they just had probably their strongest quarter ever. Everybody has different situations. You could convince yourself to do one or the other depending on your portfolio or your allocation. Maybe you have too many vehicle companies in your allocation. In the US right now, robo-taxi services like Waymo are really pushing it to get into more and more major cities because they know that's probably going to be the future of transportation, and it's going to be interesting to see how companies like NIO, GM, some of these other major car manufacturers are going to adapt to something like that. But this still might be a far-fetched thing that's not going to happen for years. Personally, I wouldn't get in on NIO right now. It's just not the type of investment I look for. They are interesting just because of their jump in year-over-year revenue, their EPS beat, their revenue beat, having a profitable quarter, considering what they do. I've known about their battery swapping. I didn't know exactly which of the electric car companies did that. I'd heard that China had a company that did that, and I thought it was a really great idea that more electric car companies should probably adopt, like Tesla, for instance. But that doesn't mean I'm in on their stock for my personal preference right now. Again, none of this is financial advice, and I'll see you in the next video.